The power of avoiding major bear markets. This is Bill Scheid from Applied Finance Research, and that's the topic we're going to cover in this video. So first of all, I'd like to begin this video with a belief. It's not just what you make in bull markets that defines your long-term performance, it's what you keep during bear markets. This is in alignment with Paul Tudor Jones, who has the belief, don't focus on making money, focus on protecting what you have. So in this video, I want to take a look at two of the hidden costs of major drawdowns. And the first one is system hopping. And the idea here is, yes, drawdowns cost us money, but they can cost us more than just money. Drawdowns compound against us emotionally, not just mathematically, and they can lead us to system hopping. And we jump from one system to another. As soon as our system has a drawdown, we abandon it, and we're leaving behind what could be an otherwise profitable system. The deeper the hole, of course, the harder it is to climb out. And when you get into one of those major bear market drawdowns, it becomes much more likely that you will abandon your system. We have to remember that if we get into a situation where we have a 50% drawdown, like we did the S&P 500 experienced in the financial crisis of 2008, it requires 100% gain just to break even. And that can really shake someone's psychology. And the point here is that systems work only if you stay committed. As Dr. Van Tharp said, the goal is to survive the worst case in the short term so you can achieve your system expectancy in the long term. In other words, reducing major drawdowns helps reinforce our trust in our systems. It helps us avoid system hopping, helps us stay in the game so we can make money in the long run. One of the second hidden costs of avoiding or experiencing major drawdowns, one of the benefits of avoiding major drawdowns is related to psychology and stress. Major drawdowns can trigger the fight or flight response in us, and they can increase decision fatigue, they can lead to emotional trading, and they can impair our cognitive function. As we know, as humans, when we're under stress, when that fight or flight response is triggered, we are programmed such that we do not think as clearly and efficiently as we do when we are in a more calm state. So of course, staying calm through tough markets helps us keep rational, it helps us keep disciplined, it helps us stay systematic. So not only does preserving our capital preserve our clarity, it also preserves our sanity. And the fewer emotional decisions that we have to make, the better our long-term edge. So at the end of the day, avoiding drawdowns helps us free up mental energy for actual strategy execution. It actually helps us stay clear, stay calm, stay sane, and make decisions that help us achieve our long-term edge. So why is avoiding losses one of the keys to real alpha? Well, long-term outperformance often comes from capital preservation, not constant market heroism. And the reason is that lower drawdowns equals a higher compounded return, even if we only have modest annual gains. So when we avoid a major bear market, when we avoid a major drawdown, we keep that capital. So when favorable market conditions return, we have more that we're compounding on. And so we actually don't need market heroism and shooting for the moon and trying to make giant gains, because if we have a greater base to compound, then modest annual gains will actually get us further in the long run. The other thing to keep in mind is that reducing volatility helps improve our risk-adjusted returns. So those are metrics like our Sharpe ratio, our Sortino ratio, etc. So what are some actionable takeaways from all of this? So first of all, know yourself as a trader, know yourself as an investor, especially your pain threshold when it comes to drawdowns. Make sure you have a realistic sense of how much you can actually tolerate. Understand your system, know how it behaves in bear markets, know what adverse conditions look like for your system, and understand the size of the drawdowns you should expect, both your maximum drawdown as well as average drawdowns. Play defense first. Before asking, how much can I make? Ask yourself, how much could I lose? And finally, you don't need to beat the market every year. You just need to stay in the game. Avoid the bears and let the bulls take care of themselves. This is Bill Scheid from Applied Finance Research. Thank you very much for watching and happy investing.